Make sure I'm recording. We are live. Okay, beautiful. Okay, welcome everybody to this beautiful Tuesday afternoon. My name is Mark Proberg, CPA. In case you haven't talked to me yet and we haven't discussed in person, what I do is I run a CPA practice and consulting firm focused on real estate and business tax strategy, where we are thinking proactively to best navigate the world of taxes and accounting so we can minimize your taxes and make the most smart and sound decisions with your taxes and your finances to help you in reducing your taxes, freeing up capital to reinvest in your portfolio and your businesses to grow as effectively as possible and achieve financial freedom. Now, for this discussion, I chose my guest, Mark Lewis, because he's been a fantastic resource for a lot of my clients here in North Carolina and Charlotte. And he works with tons of real estate investors and he really knows the business. And with his specialization, he as a banker has been able to provide a lot of value, and especially when you compare him to maybe some of the generalists, he's able to provide a lot more flexibility and value and insight to the people that he serves. And he has helped my clients with building their businesses, and I've sent a lot of my clients to his way. Now I get lots of questions how to best finance and how to best work with the banks to finance your projects. And a lot of times I'll just say, talk to Mark, right? Yeah. And, being a CPA, I want to be able to provide as much value. So Mark's been a great resource and we talk all the time and I'm always taking notes. And I thought it would be great if we go live now so he can answer some of your questions in person and help all of you guys out. Even if you aren't in the North Carolina region, we're going to have an understanding of how to best navigate the world of partnering with your bank for success in real estate. So we're going to start off with some questions. And then what I want you all to do, as I'm asking these questions, look in the Q&A section of this chat. And if you have any questions based on your personal situations, I want you to type them in. If we have time, we might be able to go live, do some back and forth. We're going to, after we do some basic questions I prepared for Mark, we're going to get to the audience and the audience's questions to help you guys better understand how to interface with your bank and how to optimize the opportunities when you are working with the right banker and taking advantage of all the different financial packages and opportunities. So first question, Mark, can you please introduce us to the audience and give us a brief description of who you are and what you're about?
I'm a 35-year commercial banker veteran. That's what I am. I've worked at Old Blue Wachovia all the way up into the corporate office and worked for smaller organizations, Bank of North Carolina, Fidelity Bank. I've been working with PeoplesBank, is based in Newton, North Carolina. It's one of the largest community banks in the Charlotte region, but that's mostly because most of the other community banks are not community banks anymore. They've been bought. This bank has been in existence since 1912, and it's had the same ownership since that time. So we are truly a local community bank and operate that way. And that's one of the advantages when we get into start talking about how do you meet a banker and how do you pick a bank, that I can certainly give some direction there. But for the most part, I'm a commercial real estate manager.
Great. So we're going to start off with the first question is for some of my audience here is when we think about, there's all different kinds of banks, and, there's so many different options. When it comes to the first step, how do you recommend some of my clients and my audience go about finding the right bank/banker to work with to help them with their investment portfolio and their goals?
Well, I think the best way is networking, of course. As you are talking to other people who are doing the same thing you are, ask them who their banker is and what they do like and dislike about them. Because when you start talking about banks, you want to find a bank that has the right culture to support what you're trying to accomplish. Given an example, the large banks, the national banks are going to have great automation when it comes to being able to do online banking, and everything that you want to do can be online. But if you want to sit down and you want to talk to an experienced banker and it's not $1.5 million deal, you're going to have a hard time finding one, quite honestly, because that's just the way the industry has changed over time. but you will be able to find these small niche banks, because even though we've had a lot of community banks that have been purchased in North Carolina and are now regional banks, behind them are brand new banks, that have been chartered in the last 5 to 10 years, and they will hire an experienced commercial banker who will still be able to do $50,000 loans like me. Most folks who've been in the business for 35 years, they're tasked with finding 10 and 15 and $20 million loans. So the trick here is to find a banker that has the ability to interact with what your needs are going to be. And don't get confused by all the different names. A business banker, a commercial banker, they're all kind of the same. There's consumer bankers, there's mortgage bankers, and there's business bankers. Those are the three general banking. So you want to make sure that you can hook up with a business banker that also works with their mortgage banker, because you need both if you're going to be in the real estate investment world.
Okay, great. And some thoughts are also consider, so if you're thinking about networking, some sources, meetup.com, any city, you're going to find a real estate group there where you can get connected and find out, ask who's doing that, right? Some other ways, Facebook, you find some local forums. You can just type whatever, Charlotte real estate investors. You can type whatever, Minnesota real estate investors. There's going to be a group. You think of it, it exists. And also Bigger Pockets has, people are posting their meetups on the Bigger Pockets site as well. Those are some ways that you can connect with other investors and find out who's helping them out.
And sometimes a bank website's going to work too. If you just go and look for community banks around Charlotte, and put that in, or wherever you're at, El Paso or whatever, and go to their website and see. Of course, right now with the pandemic, some of the banks that said they would do this sort of lending are not doing it. So that's just a one-off for this time period, we hope.
Gotcha. So what do you think? So that kind of lends to the next question. You kind of touched on it. So your community bank, we talked about community banks, and then there's also gigantic banks. There's Wells Fargo and some of the bigger names. Can you give the audience an idea of what's the difference between working with a local community bank compared to one of the larger banks, and maybe deciding what's best for them?
Well, it's astonishing to me the number of people I talk to when we start talking about buying rental houses and financing rental houses, for instance, that have never talked to a commercial or a business banker. The only people they ever talk to are mortgage bankers. And the 1 to 4 family residential investment product is a consumer loan, but it's a consumer mortgage. And that's a great product, because typically in the old days, it was put your 20% down, get a 30-year fixed rate. They're usually priced at about 0.5% over what your primary residence might be. And that's a very, very good loan for a rental property, because that'll help your cash flow. When you flip over to the commercial side of the bank, we don't have 30-year fixed interest rates, because when a mortgage banker makes a mortgage loan, they're lending you investors' money. That money, after that loan closes, that transaction is over, it's gone. So that lender and that originating team is not at risk in any way. When I lend money on my side of the bank, I'm lending you my depositors' money, which means that I not only have to make the loan, I got to follow it for its life. Now, granted, if you've got a $30,000 rental house loan, it's not like I'm going to be looking you up every week to find out that you're making your payments, but you get the point. When you multiply that times 500, all of a sudden you've got a pretty big portfolio. So that's the primary difference. So what you were going to experience on the commercial side of the bank is going to be more with the infamous balloons. So you'll see a 5-year or a 7-year balloon, and payments will be based typically on a 20-year amortization. So what does that mean? That means it's a 7-year, it comes due. Your payments, however, will be based on a 20-year term. Banks do that for this reason and this reason only. It's a rate call. It's not because we're concerned about being in the deal 20 years. We hope to be in the deal 20 years. We wouldn't be doing it to begin with. But we'll give you a 7-year fixed rate because, banks don't make money on the interest rate. They make money on the spread between it. This is what our cost of funds is. This is how much we charge you. This is what we make, the net interest margin. So if our cost of funds go up and you see, we're still making the same amount of money, but if we fix your interest rate here and our cost of funds start doing this, we're the one who's not making money. And that's what causes banks to go under, quite frankly. So be expecting that when you go to a commercial bank or a business banker, and they'll be talking to you about what type of programs they have for term financing. Now we've got construction financing for fix and flips and new vertical construction and that sort of thing that we can talk about if that's of interest.
Okay, so when trying to decide between the larger banks and then the smaller banks, it sounds like the decision making on the smaller banks side is going to be they have a they're taking on greater risk with these with these securities. So maybe some of the decision making and evaluations have to do with that, or
No, I think what I'm trying to really get to is that you can get a good mortgage banker at a Wells Fargo or a BA or even an independent. In fact, some of the best ones out there are true brokers, not mortgage bankers. They can get you into these products. Okay, don't know how much of a business advisor they're going to be. They might be, because you can only get so many of those loans. In fact, industry wide, you can only have 10 of those loans, and you're including your primary and a secondary. If you happen to have a vacation home, that takes 2 slots. So you only have 8 slots. So if you've got somebody that does a lot of rental property loans, I always try to advise them to use those on your most not important, your most expensive properties. And then on your smaller properties, use the business banking side of it. So what'll happen is if you go to Wells Fargo and say you want to buy a 1 to 4 family residential and you want to put 20% down, they're going to send you to a mortgage banker, and that's fine because they'll do a good job for you. I hope. Hopefully, it won't be the same that we do, but you know how that goes. But if my customers come to me and we talk about it, and I say, well, what are you trying to accomplish? How long are you going to hold it? What's your interest rate risk? Because obviously, if you get a 30-year fixed interest rate, you have no interest rate risk over 30 years, or even if you got a 15-year fixed interest rate, no interest rate risk. So that's why you want to save those. If you're going to be doing a lot of them, then you start weighing the issue of interest rate and risk, and then liability. Because at some point in time, most of my customers end up getting out of the mortgage banking world and getting into the commercial banking world strictly because they can put all their assets in LLCs and S corporations, and they literally can build a business, develop a relationship. But my loans are not transactional. Mortgage loans are transactional. My loans are relationships. And so not only do I want loans, I want deposits, I want equity lines, I want your consumer loan deposits. The bigger the relationship, the better. And a lot of folks who wouldn't about a year ago or less than a year ago, it's been so long, didn't understand how important it was to be able to have a banker you can call by name and a cell phone. They found out real quick when the PPP program came out. You were just a number in some of these large banks. In my bank, you can call me and say, I want this, and will you help me do it? And I helped every single one of them get their PPP loan, for instance. So relationships are important, and advice.
Yeah, there was a lot of controversy when that came out on, a lot of manipulation of the systems by some of the big banks that may have been mentioned, but I don't want to get sued for. Well, that's public information. There's some really unethical things done by these big banks on how they manage their funds on that. And a lot of us were hearing because us CPAs were providing that support, and we were advised to look at some of the smaller banks that were doing things in a much more proper and ethical manner to serve their customers. Now, the another thing that I wanted to talk about was the business line of credit.
Sure.
The business line of credit, I've seen some of my clients been able, the advantages of that are, you can get access to capital a little more quickly. And,
A lot more quickly.
Yeah, a lot more quickly, and you don't have to deal with the same the same cumbersome nuisance of having to get through the appraisals and everything else. If you can just access that cash, you can make cash offers. And when you make cash offers on real estate, you can usually get a really good discount, and you can close when you present to the seller that you can close in a couple of days with a cash offer from a business line of credit. I was hoping that you can even go maybe a little deeper and give some insight on how to go about thinking about a business line of credit, where the interest rates, and and what my audience can be thinking about with using that as a way to financing purchases of real estate.
Yeah, so let's talk about lines of credit in general. The types of credit vehicles that we typically see in this arena are credit cards. You get your $25,000 or $30,000 credit card with no interest for 6 months. I see that's used a lot. Don't like that as a banker, by the way, but it is what it is. Then you can get unsecured lines of credit. Those typically can be an overdraft line on your business checking account for $10,000, for instance. You can get one at Capital One, which is nothing more than a giant credit card, but it's unsecured. Then that's not what we're talking about, by the way. So we come over to the commercial banking side and say you want to get a commercial line of credit, and so you're talking usually lines of $25,000 plus. I will tell you that when I'm making loans and making credit decisions on lines of credit for real estate people, they are always going to be secured by real estate. Because in the old 80-20 day where the bank provides 80 and you provide 20, well, if I'm providing the 80 and I'm providing the 20, then I'm not making the profit. I'm taking all the risk. So we'll kind of do the 80, so to speak, and that is what we typically do. We will loan on 80% of cost, not on appraisal. Key difference here. Okay, but that being said, so I got a builder that wants to buy a bunch of lots right now, and he has 2 residential townhomes that are worth about $180,000 each. And so I got a $360,000 worth of collateral. I can loan 75 or 80% of a line of credit against those 2, as long as it underwrites. Of course, got to be able to pay it back. And so now I've got $250,000 line of credit or whatever I've got that is there, and it's available for him to use. And all he's got to do is call me and I'll move the money over. I don't ask him what it's for, because that's not what we do when we do lines of credit. In fact, I think you probably can just move it over online yourself and pay it back. But the trick here is remember, it needs to be a line of credit that goes up and down and up and down. It's not meant to take the place of a term loan. Now, if you're going to buy something, if you can do a fix and flip, you buy it for $50,000, put 20 in it, and got 70 in it, and sell it for 110, and you want to use the line of credit to do that. That is clearly the least expensive way of doing it. Whereas the bank, you come into the bank, you're going to have to get approved. We're going to have to get an appraisal. You're going to go back through and get you're still going to have to closing no matter what, but you get the idea. And then they're going to monitor it. Whereas which has inspection fees typically, not at my bank, but at some banks. So on a regular operating line like that, or a real estate secured line, that is a great facility. Now, but I'll be honest with you, I don't have a lot of people coming up and saying, hey, I got these 2 paid off pieces of property. Will you give me a line of credit against it? It's usually I've got these properties worth $400,000 and I owe 200 on them. Can I get an equity line or a line of credit for the loanable equity? So, and I'd say, well, yeah, but no. And they kind of look at me and I say, yes, I can get your line of credit if you want to access that equity in there. I says, but your first mortgage is going to have to be with me. So that's exactly what we did. I think we had, I don't know if we had 4 individual loans or whether we had 2 loans with two duplexes. But the point is that I made 1 new loan. Fortunately, rates were lower, so it made sense to do it anyway. And we were able to put a first mortgage on there, and then the second mortgage was, we don't like using the term equity line, but that's effectively what it is that you're getting a line of credit on the equity. And so for our lines of credit, we can do them, since they're secured by real estate, we can do them for 2 years. So we will commit to you for 2 years. At the end of 2 years, we've got to look at how you've handled the line of credit. If you have a $150,000 line of credit and it goes to 150 in 3 months and it never moves for the next 2 years, at the end of 2 years, you're going to be starting making principal and interest payments, or you're going to pay it off and go somewhere else, one or the other. So that's why we want to be in a first position. And we underwrite the real estate, because typically the real estates are rental houses. And so we actually underwrite a full term loan to the total of both the line of credit and the first, and make sure that it can be repaid from the collateral. So, but that is a great credit facility.
Yeah. I think this is going to be great for a lot of my clients who started off with maybe long-term buy and holds or fix and flips. And then when a lot of my clients are looking to go out to leave the W-2 world and into the world of being a full-time investor, a lot of them are still going to be looking into flipping houses, or maybe maybe they're going to have other sources of active income like as real estate agents. But with the flipping, and that's, they've already built up a decent amount of equity and experience from what they've started out with, and that can help with with obtaining that capital to continue to have those, those additional sources of complementary income to
Yeah.
coming in as they're building their passive income streams to make sure that they can maintain a good quality of life as they build their wealth.
And that is the key for us. We as a community bank love the guy that's got, making $125,000 on a W-2 job and comes in and wants to borrow money for rental houses, up to 4, 5, or 6. And sometimes they end up, and ultimately that conversation begins is, how do I transition out of a W-2 job into working for myself as a real estate investor? And you hit the nail on the head when it comes to working capital and how much, your own cash. When you do a fix and flip, you put your money in for a short period of time and you get it back out plus profit. On a rental house, you put your money in and it's frozen.
Mm-hmm.
Unless you can figure out how to do the cash out refinance, which most community banks are not real excited about on the commercial banking side. Now, if you were getting money out because you were putting money down on a new deal, that's fine. I'm just talking about regular cash out. Whereas the mortgage banking world, not right now, but in general, wouldn't ask any questions of what you're going to do with the money. We're going to want to know where the money's going, and then we have to kind of approve of it. Not a lifestyle or judgment, but you know what I mean. So, yeah, and that is the hard part, though, because ultimately, if you're going to get into active real estate management, the big thing here is to try and get away from is to get everything into an S corporation, probably an S corporation. It can be an LLC that files as an S corporation. You know as well as I do. Because when we underwrite a global cash flow. So when you got your W-2 salary, we take all your W-2, we take all of your rental income, we take all of your, we don't take your capital gains or losses, so that's good or bad, and we put all that together, we put in all the payments, and we analyze it. Well, if your combined income minus your taxes is $100,000 while you got this W-2, and over 3 or 4 years you transition and you're over here and it's still $100,000, then you're fine. But they're getting from here to here is not always as easy as it sounds.
Right. And the S corp is something that I've discussed with a lot of my clients when it comes to flipping houses, and also occasionally we will see the value of a C corp, especially for some of my clients now with the Tax Cut and Jobs Act and the flat 21% income tax bracket. The C corp becomes a little more popular, especially because that C corp is an entirely separate entity now, and now we don't have to worry about that with the income state tax only being able to deduct $10,000. We can deduct as much as we want when it's in the C corp. And also with AMT, alternative minimum tax becomes less of an issue when we can shift some of our income into that C corp, which is an entirely different taxable entity.
Sure.
Some tax planning there. Very cool. What do you think about? So I know we touched on this. Is there anything else that you can help us out with understanding you think we should know about with understanding the difference between conventional and commercial mortgages?
Well, yeah, there are some reasons why you would want to go over to the commercial side versus the mortgage side. Mortgage side, pretty much you got to fit in the box. I mean, your property has got to be one property, one house on the property. Your borrowers have got to be individuals, okay? And again, you'll be limited by how many slots you have. If you want, but the good news is you can buy a 1 to 4 family product that way too. So if you find a quadplex, you can still do it in the mortgage bank. But when you get more than one building on that property, or if you get to a 5+ situation, a nice little group of 5 duplexes is a good 10-unit, apartment complex. Those are the types of deals that you do over on the commercial side. We're much more flexible on what we can do. We're not, if you don't hit the credit score number on a mortgage, you're not getting it, period. On my side, I can look at it, I can set that credit score. I can say you got to have, 720. So the next three I pull will be 718. You know how that goes. We have guidance. We don't have requirements. And so we're able to use our brains. And sometimes, one of the biggest challenges I have with folks who are active rental property owners is their tax returns never seem to catch up with their current situation. I mean, your tax return, if you buy a house, 6 months in, you're going to get all of your depreciation, but then you can have your repairs and your closing costs, and everything's going to be on there, but you're only getting a half year's worth of rent. So it's going to produce a loss. Well, I have to count that. Or do I go and do a pro forma, take that one property out and do a pro forma on it and say, this is how much he's getting every month, take out 10% for vacancy and 20% for the expense factor, give him 70% as his net operating income and drive on, which is what I typically do. So at some point in time, your tax returns might catch up, but that's only when you've stopped adding properties into your portfolio. And so from those who are trying to make a living out of that, I do have a couple who do active property management. I mean, they're out there, they've got the good websites, and so they're getting 15% of the rent every month because they're doing all the placements and handling all the maintenance and all that sort of stuff. But they're also realtors, and they also do their own thing. They also do development. So when you hear me talk, we're kind of a dirt bank. Most small community banks are dirt banks. So what does that mean? I mean, we do everything from buying raw land, buying lots in subdivisions, letting you buy a bigger piece of property, putting a road in, and creating 10 lots, development loans. And yeah, I've done 350 lot developments too, but I'm not at a bank now that wants to do those. That's too big of a risk for a small bank. But if you've got a 5 acres, you want to carve it up into 5 lots or 10 lots, and put a little road in there. Yeah, that's possible. The fix and flips are nothing more than a construction loan that I do for my builders, that where instead of buying a lot, you're buying the lot with a house that needs to be repaired on it, and then you have a construction budget on top of that. We get an appraisal of what it's going to be worth when it's done. We loan you 80% of your costs. Okay, all of your costs, not just your hard costs. And so you do have to have some of your own money in it, but the purpose of the fix and flip is to sell it. And in this market, if you can't sell a piece of real estate, you got a dog, because there's no real estate available. And so that's been a very good product for us as well. But we do all of those. I mean, I even did I had a builder who had 10 lots that he wanted to build duplexes on it. So I did one construction perm loan for him, gave him 12 months to build all the houses, and in month 13 it turned into a term loan. He didn't have to come back to the bank or anything. Had a fixed rate for the whole 7 years.
Right. So it sounds like it's a good lead into the next question that I was going to ask, and you kind of touched on it already. It sounds like once you go from the conventional mortgages to the commercial loans, the process by which you evaluate whether or not someone will qualify is more of instead of it being a rigid quantitative type of analysis with credit scores and ratios. There's a little bit more of a qualitative, interpretive element of this, where you're building relationships and assessing assessing the whole picture for how to lend to these people. Correct?
Yeah, I think there's a lot. Now we're still doing all our ratios. I mean, we're still math geeks. We have to be. But there's a difference between consumer finance, because the reason consumer finance has all of those, all that box you have to fit into, is because, quite frankly, you have to treat everybody exactly the same. Mm-hmm. And I'm a big believer in that, by the way. But the fair lending laws require that. When you get over to the commercial side of the bank, a lot of those regulations don't apply. And that doesn't mean we're out there treating some people different than others. That's not who our DNA is. We want to treat everybody the same. But what it gives us an opportunity to, if a guy comes in and wants to borrow $100,000 and his debt ratios are too high, but he's got $500,000 on deposit with me, well, maybe I should lend him the money. Whereas the mortgage person can say no. Just can't. So I mean, there's reasons for to be able to justify. It's called mitigating the risk. We identify the risk, we mitigate them. But on the business side, you know, in the consumer world, you've got fixed debt ratios. Okay, the commercial is the exact opposite of that. You have debt coverage ratios. So we take all of your gross income, take away all your expenses, including your taxes, and this is how much money you have left. And this you're here, and these are your payments when you add them all up, including the new debt. How does this compare to this? We want to see about a 1.25 coverage ratio or higher. The higher, the better. So that's the cash flow is important to us. Liquidity is extremely important to us. You know, and it should be to everybody because cash is king. But if you've got $200,000 of cash sitting on the sidelines, you go in and buy a $100,000 piece of property, and now you only have 100. Well, 100's still pretty doggone good, but depending on how big your deal is, though, if you're doing $1 million deal and you got to put $250,000 in it, you give me a personal financial statement with 100 on it, I'm gonna start scratching my head. So liquidity is important, and then on the credit side, again, I think I mentioned this to you earlier. I did have one group who kind of came in and wanted to do some rental houses with me, and I pulled the credit report, and there was $120,000 worth of credit card balances on there. There's no credit guy in the world that's going to approve you for a loan if you got $120,000 worth of credit card balances. Just not going to do it. And so, so what do? We try and find a way to get that onto a mortgage somewhere. Because usually what that is either stranded cost, or should I say stranded equity, or lack of equity. So.
Okay, cool. So, and like to continue all along that lines of that questioning. So, and I have a lot of guests and clients who are, who are working their W-2 jobs, and they're building up their equities, they're finding success, and they're ready to leave their job pretty soon. And I'm constantly being asked, how am I going to be able to qualify for these loan vehicles after I no longer have my W-2 income? And also, what are the things, as we were talking about, how can we get the bankers to sign off? What can we show them? How can we communicate with these bankers to sign off on lending on maybe some of our flips or future purchases for long-term buy and holds after we've left our our W-2 jobs, and now we may have our income is going to look entirely different on our 1040s. When you're working with me, we're doing some cost segregation and bringing your taxes totally down. So how can we, what can my audience think about on what's during this next phase? And even while they're keeping their W-2s, what do we have to do to get, the banks to say yes?
Well, ultimately, you've identified the big struggle. Okay, there's two things I would kind of talk about. First off is all the builders that I've worked with in my career have all started with, their first project. How did it get financed? Well, so you're collateral heavy on that. You either had your daddy was a builder and he's co-signed for you on your first loan, or maybe you, instead of putting 20% in, you put 40% in to lessen the bank's risk. But you started, and then that generated some profit for you that you got to pay taxes on, and showed on your tax return. And then you did a second and third, maybe at the same time, and you did two or three, and ultimately after tax year, you're building up your S corporation such that it in and of itself is going to generate a good income. I mean, I've got one right now that I'm pretty sure came from you, that the guy is building. The guy is a realtor.
Okay. Oh yeah, that's going to be a good one.
So, he gets it on both sides, and he's running an operating company as a realty company. He's building on the side. And I've got other guys who aren't builders. They're just real estate investors who are hiring him to build the house. So he's doing fee building as well. So you pay him 10% over cost, or 8% if you're lucky, or 15% if it's probably market based. But then you get everything on top of that. You say he's a fee builder. He doesn't sign a guarantee or anything. You borrow the money, hire the contractor to build it, and then you sell it. For instance, that's another one. But in order for the W-2 to completely go away and end up with, being able to borrow money for fix and flips and everything, because fix and flip is nothing more than construction loan. Just like one of my contractors coming in and saying, I got a contract that's doing 6 houses a year. I had a contract that's doing 2 houses a year. It depends on how much money you have to make, and also depends on your spouse because, quite honestly, in the mortgage banking world, they don't want your spouse on here if you can qualify for yourself because that's just more documents they've got to get. On our world, we want your spouse on there too. And we can't require it, by the way, but we want it because we can count any income they bring to the table. And we also count their expenses. But in the state of North Carolina, and I don't know all the other states you may work with, the laws favor joint ownership of these things. So it's important. So if one of them is if one of the spouses is trying to get more into real estate, and the other one continues to grow in a W-2 job, you kind of have the best of both worlds.
Mm-hmm. And
somebody can definitely, then the other W-2 person can quit once this one gets going big enough.
Yeah. Another thing to think about is for some of you who maybe are looking to build up more capital and may not have all the capital to really do the projects they really want to do. Obviously, you can start small if you're not going to qualify for a multi-million-dollar loan. But another great idea, coming back to networking, right? You're going to find people who are really interested in investing in real estate and are really excited about it, but they don't have the time. If you network and or maybe within your own network, you go to the meetups or you reach within your social circle or whatever, however you're meeting people. There are lots of affluent people out there who would love to have a piece of real estate and don't have the time. And if you can offer your skills, your hustle, your expertise to partner with them, that's another great way to do these bigger deals and help them qualify, with them, you leverage their, their credentials to qualify. And also
call them the money men.
Yeah, but talk to me before you do it.
Yes.
And we likely will want to talk to an attorney because when we structure these partnerships, there are all sorts of things we can consider to make it more appealing, that will make it more appealing to the borrower based on their circumstances and how they may want to utilize some of these passive activity losses. You also want to consider that this will become a regulated security, and we have to worry about Reg A and Reg D most likely, and we may need to hire an attorney to write up this partnership agreement and follow certain standards and guidelines to make sure that we are compliant in the way we issue this partnership interest, which is now going to be treated as a regulated security. That's something a lot of people kind of bypass that step. So it's something that we like to think about. Other financial instruments are maybe more flexible, but you're going to see a higher interest rate, as we see with some of the hard money, the private money lenders.
Right.
Are another option, but with those instruments, you're going to see higher interest rates than we will see with the banks. But
when somebody's been working with a hard money lender and they've never worked with a commercial banker before, and they come in and say, well, okay, well, what's your rate? And I said, well, prime plus one. And I said, well, what's that? And I said, 4 1/4. Their jaw drops. Now, of course, prime's historic low right now, but still, I mean, a typical construction loan for me, there's prime plus one variable, and you only pay interest on the amount of money that's been advanced under the line on a daily basis and a 1% fee. I mean, the bank's happy with that return, and it's usually a pretty good deal for the consumer as well, or I should say for the real estate investor.
Yeah, and I think that so many people you're looking at hard money and private lenders, but a lot of people don't realize that some of these banks are also going to work with them and give them much more favorable terms. So
this has been a standard. Prime plus one or 1% fee has been a standard for 30 years that I've been doing this for construction lending. And I'm not saying we've never gone below that, because in reality, if I'm doing a $1.5 million house deal versus $150,000, it's the same amount of work. It makes more sense to give the $1.5 million a prime plus a half instead of a prime plus one kind of situation. But right now, when you're talking about term finance, and by the way, all your lines of credit are going to be variable interest rates. That's just the way it is, because we can't forecast how much money is going to be owed on that. So it's hard for us to fund our bank without using a variable interest rate. But you can get variable interest rates on your term finance as well if you want them. But we're at historic lows. You should be getting fixed interest rates right now. And so, like I said, the fixed interest rate for a commercial side on a reasonable size loan, let's say $250,000, That's between 4 and 4.25 for 7 years with payments on a 20-year amortization and maybe a 0.5% fee if you're buying or refinancing. So that kind of give you a ballpark for what you might expect from a community bank right now, at least in our market around here, because competition does play into that as well.
Gotcha. Okay, great. I'm gonna get to the audience's questions, but before I do, I just want to clarify one more thing. So when we compare just to backtrack a little bit. So with the business line of credit, we're securing it with the equity in the home, but I think the difference perhaps, and correct me if I'm wrong, but it sounds like the difference between that and a home equity line of credit is, or maybe you can help clarify the difference if I'm off, but it sounds like,
One's a consumer product and one's a business product. The
okay.
consumer product is usually a 15-year equity line up to 80 or 90% of the value of your primary residence.
Mhm.
Okay, that is a very important distinction. It's your primary residence. And so everybody, all of your customers should have the biggest equity line they can get. Well, I don't need one, Mark. Well, tomorrow you might, and then the bank may say no because you lost your job. Well, if you lost your job, that's when you need the equity line to stay afloat till you get your new job. So go get your equity line now. That's a consumer product. On the commercial side, we're talking about lending you the lendable equity in commercial real estate.
Mm-hmm.
And it's unlikely if the tide doesn't go well for you on in life, it's much less likely that you will walk away from your primary residence than you will an investment. And so that's why. And so the equity lines are 15 years. You get to use it as much as you want. The interest rates are usually even better than commercial lines. The commercial line still gives you quick access to capital, and there's not a lot of supervision as to what you do with it, but it's only going to be for 2 years at the most. And at the end of 2 years, I'm happy to renew it every 2 years. Got to get new property valuations. There's going to be some expense involved with it, but the ability to go ahead and grab that $80,000 that you can buy this property for today versus 100 if you have to wait 60 days it's worth it.
Okay, great. Okay, thanks for providing that clarity. So I'm going to go through some of the questions now. First, I see in the conversation, do you or any bankers, I think we already kind of answered this, do you or any bankers lend money for raw land buying and selling, to purchase, i.e. a bulk dollar amount that has a fixed term and rate?
Well, I will tell you that if you're talking about buying just raw land, what exactly it is, the regulatory LTV on that is 65%. So you can be planning on putting down 35% minimum. What you will see, we will offer you potentially the same 5 to 7 year interest rates at what we would a regular term loan, but the amortization would be held to 15 years. So
are you talking about the when you say 35%, I'm sorry, I'm not sure if you said it, but 35% of the appraised value or the purchase price?
Everything is always based on purchase price and cost.
Gotcha.
Back before the recession, oftentimes it'd be based on appraised value and not on your cost. But we found out how most banks adjusted that. We'll just put it that way. Usually they're blending on cost.
Okay, great. Okay, now what kind of financing is available and would you recommend for short-term rentals?
I assume when you say short-term rentals, you mean Airbnb type financing.
Correct.
Look, there is no doubt that the community banking world is way behind in how figuring this one out. Okay, I can give you an example. We were asked to do a $1.5 million deal on Lake Norman, and so what we did was we said, well, how much are you going to charge per night? And they gave us some numbers. So we hit it with I think a 40% vacancy rate, because you're not going to have every single night for the year rented. And then we hit them with a 30% expense ratio, and then use that to compare it to the payments, and it worked just fine. Another way of doing that is that if we know what the market rents are in there, then we can go ahead and say, if you were going to do this on a long-term rent basis, what would you be able to charge? And we look at that, and hopefully that would be a good indication that it's a good property for cash flow. Those are two things that observations I can make. Now, look, if you already have the property and you have and your Schedule E shows that property and shows its income, and your accountant hadn't deducted everything that they possibly could, then we will use that to do our cash flow analysis. But if you're buying a new one, and I've got plenty, this happens all the time. People want to buy it and they're going to Airbnb it or short-term rental it, call it what you will, and we just have to kind of figure out. I know that those services will provide you a pro forma. So if you're a strong borrower, and then sometimes we can use those sorts of things. It's hard to believe this, but bankers really look for reasons to make loans, not to turn them down, because that's how we make a living. Credit guys, on the other hand, we'll talk. We worry about those folks. I don't know how helpful that is, but in my world, there are a challenge. But I have a number of those properties financed, and none of them are in any financial stress.
And what do you think about, and so I know that you said looking at long-term rates, but some of these are going to be in areas like, for instance, if we're in the mountains, we're in an area where there's lots of log cabins, and all the properties there are, short-term rental log cabins or clusters. So the most comparable properties are going to be other short-term rentals. Would you be able to consider that as a factor as well?
Well, yeah, I mean, and we have to, again, our credit departments, are just not used to this stuff yet. So how do we find that out? Well, oftentimes it's our borrower who's going to educate us, but the appraiser, is probably our best means of trying to do that. If we tell the appraiser it's going to be an Airbnb, and we need to get an income approach, then he's going to have to do some work to provide that. And when he gets it back, I can steal that, put in my memo and my analysis. But I like to say, yes, I'll do the loan before I cost you money on an appraisal, but sometimes you just got to have to go ahead and fork up the money for appraisal just to see what we can get and see if it justifies it. Again, a challenge, and I am one of those old bankers who can't teach, old dogs new tricks. I'm trying them. I've got some good folks who do a lot of these short-term loans.
Awesome. Okay. I think we kind of touched on this on the difference between a mortgage banker and a business banker. I think we kind of covered that topic. Is there anything else you would like to?
Yeah, the mortgage banker, it's a transaction. They're selling it, and it is a consumer transaction. Okay, it's consumer. The underwrite's consumer. And so you can't have one property, individual name. It can be multiple individuals, don't get me wrong, but it's a rental house, no problem. And whereas the other side is a business purpose loan. So if you're buying something for, those 1 to 4 family residential investment properties is kind of a quasi business consumer loan, but it's underwritten consumer. All my stuff is, we're lending you our bank's money. The little ladies who have deposits with us, it's their money, and we're making spreads. So that's why we're able to be a little more flexible, but we're not going to go 30-year terms on things, because they don't give me 30-year deposits.
Gotcha. Okay. Great. So I think that so we're able to answer all the audience's questions, and I'm going to post this, and I might get some inquiry, so I'll be able to one thing I would like for you to provide to the guests and the audience that will listen to the recorded version of this. Can you give us the best way to reach out to you? And if you have any other, what I always like to give to my guests is a call to action.
Sure.
So anything that you would like from the audience, or you are offering to anyone who listens to you, anything that you would like to request or provide for the audience?
Well, it's all about networking, make no mistake. I mean, that's been the secret to my success. I mean, quite frankly, I'm at a good point in my career where I'm not doing much cold calling, they're calling me. And that's good, because a lot of banks right now are not doing this. So construction and or rental. So there's some of those banker friends are sending them my way. But I'm happy to provide my email address and my cell phone number. I mean, I don't have any problems giving those out at all, and you've got them. And I can call them out now or put them in the chat box, whatever you want to do.
Yeah, why don't you put them in the chat box, and I can put in the comments of the recording. Would that be all right?
Yeah, that's fine with me. I just want folks to know that from my perspective and what the type of deals that the types of customers that I'm able to help is, as a community bank, we strategically are in the Charlotte region up through the Raleigh region, okay? And we're actually skip over Greensboro and for instance, so the Triad. So my primary lending is in the greater Charlotte region into upstate South Carolina. Not a lot of that, but mostly on the northern side of Charlotte. So if I got somebody who lives in New York and wants to do a rental house in my market, I'm not going to do it because they don't live here. Now, if there's a partnership and one of them, I'm doing one now for a partnership where one of them lives in Monroe and the other three live somewhere in the country, but it's a rental house. So there has to be a reason for me to make that loan. The only time I'll be able to do stuff for people who are out of state and don't have partners locally is if it's an income producing property and they're wanting to borrow about 50%. And so that's a possibility, but those are usually, Bojangles or Wendy's or things of that nature rather than rental houses. But for those folks who are in the greater Charlotte region, and I'm not the only commercial lender at the bank either. We've got another 14 of me. So, and I hope they're all better than me at what we do.
Yeah, great. And I'll I always use you as a resource just for general banking, and so for some of my clients, we're gonna
happy to help. Anytime anybody, I love helping people. You got a question, you call me or email me, or go through Mark. Either way, I'm happy to assist.
Yeah, really appreciate your guidance so far. So if you could type in your contact info in the chat for our current listeners, and I can put your info in when I post this, and hopefully we can connect you some great people as well. I hope you guys, this will all be recorded and posted to my site and my YouTube channel. Also, I want you guys to, I want to give you guys an idea of some other things we have coming up. Now, what I'm trying to do is to try to facilitate as many relationships and connections as I can. So if you are new and I don't have your information, obviously I'm going to see this. If you register to attend the webinar, I will see your email, but I want you to tell me more about you and what you're doing, what you're looking for, what you can offer, what kind of services are you providing, so I can help you. Maybe if I can connect you with someone who can help you along your journey to reaching your goals, just let me know a little more about yourself. Now we're going to keep this going and keep on bringing on webinar guests and people who I think can provide the most valuable to my clients and my audience. So here are some of the next topics that we're going to talk about, and I'm going to be bringing on other people who I really think you're going to enjoy. We're going to have several panelists. I'm still solidifying a date, but I will tell you, make sure you're on my emailing list and you follow me on Facebook and you get your invites. The next topics are going to be investing out of state and in the Southeast. So I'm going to be bringing in some active real estate investors in North Carolina and Louisville, and maybe some others in the Southeast. And we're going to talk about the market of the Southeast and what kind of ratios and profitability and the development and what kind of what the future holds for the Southeastern real estate market. And I'll be throwing in some tips. And also we're going to talk about that for those of you who are not from the Southeast, some strategies for investing out of state for saving money on your taxes, and also some business strategies. So if you are in California, New York, a lot of those people are eyeing the states, trying to buy it up. A lot of people, because it's just so much easier to get to purchase your first properties there. So tune in for that. Next, we're going to talk about foreign investments. This is going to be great for syndicators. If you have potential business partners and investors out of your country who are interested in the United States market and you want to get financing, there's lots and lots of things to consider. I'm going to bring an international tax attorney. We're going to talk about how to partner with and obtain financing and capital with foreign investors. We're going to talk about investing in New York City. I got a lot of friends and connections in New York City. How can we make it possible? If you can make it there, you can make it anywhere. We're going to get some people who actually do it and talk about some strategies there in New York City. Also, I'm looking for suggestions. So either you're listening live or recorded, send me some suggestions of some webinar topics, and I will consider them and maybe include them, and give you some props for giving me some inspiration here and keeping this thing going. Another thing I want to talk about is discovery sessions. This is my call to actions. I provide a free tax discovery session. This is just a chance for me to look at where you're going, what your goals are, and to see how things are going, what missed opportunities we may have missed out on prior years. What opportunities do we have in the future for our tax planning? A tax plan will always cost less than the savings it will generate. So we can assess whether it's time to invest in a tax plan or not. So that's free, and I'm going to, just email me, or I'll email you. Just contact me and block off a time on my calendar. I'm going to post that link for a 30-minute session for the discovery session in the chat, and also on the Facebook page for this event. And I will email those of you who are attending live more details on that. So thanks everybody for attending, and this should conclude this webinar. One quick question that came through: will you include Florida, or do you have a couple of Panama? So we have investors in Panama City Beach. Do you think that we could possibly get something going, or maybe
if they have a local partner?
Okay, if we're a local partner, we can make it happen.
Oh yeah, I mean, I've got folks from all over the country that are customers, but they're usually in a partnership, and so they're just a guarantor. And that's the issue. When you're a guarantor and you don't live in North Carolina, it's problematic to execute on judgments and things. Not that we ever want to talk about that, but it's real life.
Okay, gotcha. Okay. So, but another thing we can do is, again, like we talked about, how to find the right bankers. We'll get in there, we'll network, we'll reach. Maybe you have some suggestions for that region as well. And if you're to find someone local who best fits you, the networking is crucial. It sounds like for lots of things with finding the right professionals and all that great stuff.
Right.
So, okay, great. So I hope everybody really enjoyed this and got a lot of value, and I hope this encourages you and gives you some ideas on how to navigate the world of working with your banker and financing your future investments. Stay tuned. We have lots of great stuff coming your way. Contact me if you want to learn anything more about some of these topics. I do provide business consulting as well. I'm happy to help you along with the way on your real estate journey. Until next time, thanks for attending. Thank you very much, and everybody have a great day. See you soon in the next webinar.
Thank you, Mark.
Thank you. Thank you.